Welcome, everybody. It's coronavirus stay at home day 9, and we're going to talk about the money market. So, here is a graph of the money market, and I want to show you this graph automatically looks a little different than the graph of the loanable funds market. And something should be jumping out of you at you right now, and that is the supply of money. You'll notice the supply of money is inelastic. And then you see here the demand for money. So demand for money is elastic, and we'll talk about both of those in depth. On the left-hand side of your graph, you see the nominal interest rate. So here we're talking about nominal interest rate, and that comes from our quantity theory of money. Remember, money, M is the money supply, V is the velocity of money, and that gives us price and quantity, or nominal GDP. Gives us GDP not adjusted for inflation. We're going to have nominal interest rates here in the money market, unlike the loanable funds market. Loanable funds has real interest rates. Money market has nominal interest rates. And then, of course, we have quantity of money here. You can title the graph money market. Again, let's be very careful with our titling of our graphs, because this is a great way to do well in the AP exam and make sure that you show that you can draw graphs correctly. For money market, the supply of money is inelastic because the Federal Reserve, our central bank, controls it. The Fed is not a market, so the Fed doesn't adjust the money supply based on interest rates. It makes changes unilaterally. So the Federal Reserve decides we're going to have a bigger money supply, and they take actions to increase the money supply. The Federal Reserve decides we're going to have a smaller money supply, they take actions to decrease the money supply. Now, just because the Fed pushes money out by, say, buying government bonds, and we'll talk about that in depth a little later, or lowering the reserve ratio, banks don't have to multiply that money. They don't have to increase the supply outside of the bank. However, we're in Econ 101, so we're going to look at the Fed alone. For the most part here, we will discuss that in writing, but in terms of our graph, we are going to have a completely inelastic money supply. Determinants of the money supply for our course are Federal Reserve actions. Another way you'll see that is central bank actions, because remember, we're not the only country in the world. Other countries have central banks with similar activities. Why don't we keep all of our money in cash or bonds, or move it out of money entirely into stocks and gold? And there's a couple reasons. For one thing, holding cash or holding demand deposits, so M1, we lose an interest rate that we could be making on that money. The interest rate that I can make in a savings account or on a bond is something that I give up when I hold cash money either in cash or in a checking account. However, if I put all my money in bonds so that I can have an interest rate, my opportunity cost then becomes the transaction cost. So, for example, many people are seeing economic times getting harder, and if I needed some money to pay an unexpected bill or something changed very quickly, I would have to sell my bonds. There are literal costs to that. You pay a fee typically when you buy or sell a bond. There's also costs in terms of time availability. Bond markets are only open Monday through Friday, 9 to 4, so you can't liquidate a bond on a Saturday or at 8 o'clock at night. However, you can reach emergency cash and checking stores within that time. So there are costs for moving money back and forth. So I don't want to keep my house payment, even if I've got that saved up, I don't want to keep that in the bond market, because the little amount of interest that I would make would be offset by the prices that I have to pay to move things in and out of the bond market. Let's take a look at the demand curve for money. So the demand curve for money slopes downward, and the reason is the quantity of money you're willing to hold. If we assume the opportunity cost is loaning it out, particularly to, say, bonds, which is the cheapest and safest way to loan money out. So, the next best thing to money in terms of safety and security would be bonds. If interest rates on bonds go up tremendously, you're going to be more willing to put money in bonds. And you're going to be more willing to say, you know what, I don't need that cash today. I'm okay with being able to get it in a few days with a little bit of cost, because my interest rates are really high, my opportunity cost has increased for holding money, so I'm willing to change it out for the lower opportunity cost of holding bonds. However, if interest rates are really low, as they are in our life right now, you would rather hold on to that cash. So you're not very likely to lend that out, particularly to the government, because interest rates are very, very low, and you don't see a good reason to lend that money out when you could keep it for yourself. So you'll keep the money in hand, you're not losing very much in terms of putting it in bonds, and you've got it ready if the perfect item comes up, you've got cash on hand to purchase that item, or if you've got uncertainty in the economy. Here are the determinants of money demand. So money demand is determined by income. And you would have to read the question carefully here because income is not that simple. I need to give you more information. So for example, incomes are rising and people are more willing to invest because their needs are being met. Or incomes are dropping and people are less willing to invest because of uncertainty. So income really kind of ties in often with expectations. What's happening to incomes, what's happening to expectations, that would affect demand for money. So it's not straightforward as just income. Price levels go up, money is less valuable. So as you hold that money, it becomes less and less valuable in your hand. So people are more willing to turn it into investments like stocks or gold or real estate, things that are seen as holding value even if the currency is in fluctuation. So price levels and money demand vary inversely. Expectations, right now, people are very uncertain about the economy. Inflation's pretty low, and so people are more willing to hold on to money. I find myself, while I'm willing to buy groceries because I'm uncertain about a shelter-in-place order during this COVID-19 crisis, I am not willing to pay extra on my house, which I have been doing. I'm not sure that I won't need that money in the future. So I've stopped paying ahead on my house and tying that money up in real estate. And what I'm doing now is keeping that money on hand in a savings account in case my income changes in the future. Transfer costs. So if it becomes cheaper to move money in and out of the bond market, I'll be less willing to hold money. If it becomes more expensive to move money, I'll be more willing to hold cash in savings because it's going to be too costly to get it out of the bond market. And then preferences. So consumer preferences for cash versus paying in credit cards, or consumer preferences for the bond market. So again, a lot of these sort of overlap, and just read the question carefully, and of course we'll be practicing with many of those. All right, so monetary policy is the control of the money supply by a central bank, and there are two types of monetary policy. One is expansionary policy, when the central bank increases the money supply, and that's done during times of contraction in the business cycle. The second type is contractionary policy, when the central bank decreases the money supply. This is done during times of expansion in the business cycle. So expansionary monetary policy varies inversely with the business cycle, just like fiscal policy. When times are hard, like they are right now, the central bank is going to take action to increase the money supply. And as of right now, the central bank is taking action that is unprecedented in my lifetime to make sure that money is available and moving throughout our economy as we've gone through a pretty severe shutdown of our consumption during this COVID-19. Contractionary monetary policy is something that you guys aren't particularly familiar with in your lifetimes as I speak this to seniors in 2020. But when the economy is doing extremely well, the Federal Reserve will try to slow things down a little bit. They'll take away the punch bowl when the party gets going. The federal government's not very good at doing that. And during the last couple of years, the Federal Reserve has actually raised the interest rates a couple of times in an attempt to slow the economy down and keep a slow, steady growth going so that we don't have too much inflation. The Federal Reserve has three major mandates. That is keeping inflation low, keeping unemployment low, and keeping economic growth going. As you remember from our Phillips curve, keeping inflation low and unemployment low is an impossible goal, but they try to keep that balance. And that's a very, very tricky thing to do. And of course, there are external actors. What the Federal Reserve does is based on the guesses that they have about what's happening with the economy, and things come and change very quickly, like the coronavirus. Now, we talked about the central bank. The Federal Reserve is the central bank of the United States, and it controls the money supply of the United States. But in questions, you may see the Federal Reserve, you may see the central bank, because other countries have central banks. So we want to make sure that you understand that this monetary supply and these tools, while they vary from country to country, generally buying and selling bonds, setting reserve ratios, are what central banks do.